Thank you, Peter, for that kind introduction, and good morning, ladies and gentlemen. I've been asked today to give a view on choosing the right markets, product sets to best serve consumers and to secure future profitability. A very wide brief, and hopefully I'll be able to cover that in this session and lead to some stimulating debate afterwards. There's no doubt, as we've heard, there's a lot of regulatory change, but our society is facing some challenging demographic trends, an equally challenging fiscal position, and a general trend towards consumer distrust of institutions and government, perhaps particularly when making long-term decisions. These challenges also present real opportunities, I believe, for the life and pensions industry to leverage our core capability of risk management to help address these social challenges while generating sustainable profits for our shareholders. Clearly, the market is set for major change. We've already heard a lot of talk about the retail distribution review. We've heard mention about Solvency II looming on the horizon as well. However, I do not believe that these change core consumer needs or the sources of value for our industry, although undoubtedly they will raise challenges in meeting those needs profitably. So I'm going to start, I hope Peter notices this, with the consumer. I am a product director, but I'm not going to dive straight into product. It's very much looking at it from a consumer lens. And I'm going to start with a review of the current picture of wealth in the UK, identify what I believe are the core consumer segments in the pre- and post-retirement market, before moving on to consider how well served those customers are today and what challenges and opportunities face the industry in better meeting those needs to generate value for shareholders. In the UK, we're fortunate to have about £8 trillion of household wealth. The chart here is taken from the ONS Wealth and Asset Survey, shows the median each household has by the age of the head of that household. A few things are striking here. First, how little wealth is held by UK households outside of their home and their workplace pension. This is generally true across the different age groups, although underneath this data there is very strong correlation between financial wealth outside of the pension and wealth overall. This is generally true across different age groups. People obviously need somewhere to live, and hence many people enjoy considerable wealth that is merely a byproduct of fulfilling that need. We know that for many people, this was not a deliberate retirement planning strategy, not least because there is still considerable resistance to the idea that this asset should be monetised to pay for needs in retirement, in turn including long-term care. We also know that for many people, pension wealth has been built up in a relatively painless way. In a deft move destined never to be repeated, many baby boomers managed to get someone else, the shareholders of their employers, to shoulder the vast majority of funding of relatively generous defined pension benefit pensions. We should treat property wealth with extreme caution. I would contend that if any generation invested in a scarce asset class with a long-term buy and hold strategy, valuations in the market would increase relentlessly. In fact, valuations will only start to fall over a sustained period if the number of sellers increased markedly. So whilst decrying the reluctance of people to monetise their property wealth a moment ago, I am also acutely aware that much of the property wealth is very dependent on the fact that many people refuse to monetise it until death. A second observation on UK household wealth, which is not news to us but is worth repeating, is that wealth is very unevenly distributed, both in general terms and by age. That 3/4 of people have less than £16,000 in financial wealth is profoundly important when considering what financial services industry can and cannot do. It shows how fundamental pension assets are, and naturally where much of our efforts are therefore concentrated. It also illustrates that unless we find a more cost-effective ways of encouraging more saving, regrettably, our industry really cannot economically serve a large proportion of the population. I say regrettably, not to curry favour with policymakers who naturally have a focus on how to help this group of consumers, but because I genuinely think it's an unfortunate position that we've got ourselves into. So, we should not kid ourselves. Yes, we're fortunate to have £8 trillion of household wealth, the vast majority of which is owned by people over the age of 45. But a large part of that is because a whole generation invested in an asset class, UK residential property, that's performed well, and many of the same generation have found a third party, their employer, who has been prepared to underwrite their longevity and investment risk. There are many segmentation models that are used in our industry. They're becoming increasingly sophisticated. For the purpose of this session, I've kept this review at a very high level today. I'm going to look at 3 broad segments by life stage and need. And I'm going to focus that on the group that own the wealth, the over 45s. So the first area, many consumers in this group are in the final accumulation phase. They're desperately trying to strike the right balance between maximising their accumulated wealth while still economically active, protecting the wealth they have accumulated to date, and planning for their retirement. This is a complex trade-off which requires quality financial advice and investment risk management. The second group are looking forward to an active retirement. They need to generate income from their accumulated wealth while protecting their remaining assets to supplement their lifestyles in retirement. In essence, they require solutions to help manage their longevity and investment risks, core capabilities of our sector. And for the over 75s, I've characterised this here as the slowdown period, although I'm not sure that my mother-in-law would either appreciate or recognise that description. Consumers need to efficiently monetise wealth and meet spikes in cost of care. This life stage not only brings the longevity risk into sharp focus, but is increasingly requiring a boost in income of liquid assets to meet long-term care needs. These segments not only own the vast majority of the accumulated wealth in the UK, but require the skills and capabilities of the life and pensions industry to help meet their core needs. We've tended to focus our efforts on the accumulation and that retirement stages with limited innovation, I would suggest, for the in-retirement sector. The retirement market is still dominated by conventional annuities, which for many will still be the most appropriate vehicle. But increasingly, consumers' needs are changing as life expectancy continues to improve. It's recognised that the shape of income in retirement has fundamentally changed. I think we would all agree with this. We will probably draw this curve in slightly different ways, but I think you would all recognise the U-shaped consumption that has started to emerge in retirement and the challenges that that is going to bring for consumers. The challenge for our industry is to respond to these changes with more flexible solutions while helping to mitigate the longevity and investment risks of an ageing population. The increasing need for consumers to fund costs of long-term care provision, I believe, presents an opportunity for the industry to develop a new market, and the viability of this market, I also believe, will largely depend on the role that government decide to play. And we look forward to seeing the recommendations that will emerge from the Dilnot Commission on funding care and support. Now, looking forward beyond the current market opportunities, the importance of the role of encouraging people to do what they should is brought out by this slide, which I won't dwell on for long, But all of us in this room live and breathe financial issues one way or another. Whereas actually, most of the UK population just find it boring. But something they know is important, and therefore it gets put off until another day. It can't be dismissed because it is important, but can't be tackled either because it's difficult. The statistic that stands out for me on this slide is that 43% of people who hold equity-based products think they have zero capacity for risk, which is a startling fact revealed by these statistics. It suggests that any mechanism designed to compensate and address the current level of financial capability through, for example, the provision of financial education have got their work cut out for them. It might sound a bit mischievous or even cynical to suggest, but it strikes me that one of the reasons that we built up £8 trillion of wealth is that because people who built this wealth had absolutely no idea of the risks they were taking. I'm certain that this is true of pensions wealth because as soon as employers understood the risks they were taking with defined benefit schemes, the vast majority closed their schemes as quickly as they could. But if you cast your mind back to the last widely held mass market equity-based product, it was the with-profits savings endowment. Up until the invention of mortgage endowments, which Peter referred to, the humble with-profit savings endowment delivered successfully for generations of savers, partly because it got people to invest in equities without them ever realising it. So far, we've seen that average savings levels are very low and consumers don't know the risks they're taking, but it's not all doom and gloom. There are parts of the current regime that are working very well, and one such part is the ISA regime. The ISA regime has a lot going for it. The use it or lose it nature of the allowance is an effective call to action which dominates the personal finance media for the ISA season and the run-up to the end of the tax year. No surprise then that the total take-up is impressive. Each year, about 14 million people subscribe to an ISA, almost 1 in 3 of those that are eligible to do so. And cash ISAs in particular have been extraordinarily successful, accounting for 10.5 million of that total, including, as you can see from this chart, the younger age groups and low to moderate earners as well. The fact that the vast majority of ISAs are cash ISAs is an issue, however. I mentioned earlier that previous generations have built substantial wealth by investing in real assets, whether by accident or by design, and whether they understood it or not. It seems to me we now face 2 choices. We can either design and market products like cash ISAs that invest in safe assets that people understand, and we could extend this thinking to pensions and have a cash pension, but we must accept that this will be a radical departure from the way that previous generations have saved for the long term. Improvements in longevity have made funding for retirement an expensive business. Asking savers to fund it with deposit products will make it hugely more so. We can continue to design and market products that invest in real assets. This is undoubtedly the most efficient way to fund for retirement, but we need to accept that many people won't understand the risks they're running. I think most of us want to make that second option. The question is how we can educate consumers not only to understand the risks they're running, but accept that risk is a necessary part of the deal. We can't force people to love taking risk, but we can help them to manage that risk effectively and develop propositions that meet their own capacity for risk. I'd now like to turn to some of the reforms underway and try and address the issue of undersaving amongst mass market customers. The first is compulsory auto-enrolment and Nest. We're supportive of these reforms at Prudential. They're grounded in a realistic view of consumer behaviour and should help to start closing the savings gap. Most of the concerns I hear expressed about Nest and compulsory auto-enrolment fall into three categories. First, in relation to the impact on workplace pensions, the risk that employers level down to the baseline 3%. And second, the related point, employees will regard the 8% total contribution as an acceptable target, enough to provide a good pension. And finally, that means testing raises suitability concerns for low earners. There is something in these concerns, though they are, in my view, a bit overdone. If we manage to get people saving 8%, most of whom weren't saving before, we'll be doing very well. And we'll have an opportunity to persuade people to contribute, increase those contributions over time. I think the private sector have a real opportunity here to play a role in encouraging people to top up over and above Nest, whilst Nest provides the underpinning to drive the savings culture of the future and to accumulate wealth into the future. My concern is more the structure of the contributions itself. Far from providing too little for those to stay in, it will encourage a large number of members to opt out, as their 4% contribution is simply too much to forgo from their take-home pay, even at the price of losing the matching contribution. We need to be realistic about the priorities of those on modest incomes and those aged under 40. These people could actually end up worse off because their employer contribution for colleagues who stay opted in will be found from the total labour costs of the firm. So those who opt out will effectively be cross-subsidising those who stay in. I wonder whether we should consider a tweak to the Nest contribution structure so that the 3% employer contribution is paid for employees whether they opt in or out. This would mean everyone was building up a pension at some level from day one. It would also simplify the system because there'd be no working out who was in and who was out. It may not be popular at this stage to be suggesting we could be regarded as a payroll tax, but the only additional cost over the current proposal will be in respect of employees who opted out, which I'm assuming everyone is hoping will be a small number in any event. Of course, the basic 3% level is nowhere near enough to provide a good retirement income, and it's there the private sector could find a role encouraging people to contribute on top of the basic level. So to conclude, we should target the baby boomer generations with accumulated wealth, leveraging our risk management capabilities to meet their needs while generating value for our shareholders. Develop new solutions to meet the changing needs of those approaching and in retirement, including long-term care funding in partnership with government. And to help create the right environment for future wealth accumulation, we should provide simple, powerful messages to engage people. We should learn from where they've been successful, such as with ISAs, where the tax deadline, the media and the industry all point in one direction and consumers respond positively to it. Simplify our communications about risk so that consumers understand that taking risk is positive and necessary to meet their future financial goals and that we can provide help in managing those risks. Lobby for an all-party consensus and stability on incentives to save to encourage a savings culture. And finally, embrace Nest for all those who we cannot economically serve. It is in everyone's interest to get the whole nation saving. And thank you very much for your attention.